So this time, what we're going to be doing is actually just making it as clear as possible about some of these bits of terminology. So it's asset allocation. One of the things we want to try and do is to be able to make, well, I've always said at Seven, things as clear and as straightforward as possible. And ever since we've started, we've always focused on asset allocation as being absolutely core to what we do. But Tom, what do we mean by asset allocation?
Asset allocation, one of those nice phrases that we use in the city, which sometimes confuses people, is really the financial services version of don't put all your eggs in one basket, to diversify your portfolio for the purpose of having less risk.
But people have always had other eggs in the baskets. What's different about what we're doing for asset allocation?
The way we went about it was to take some of the structures and disciplines that lived in the institutional world. And by institutional world, I mean corporate pensions as opposed to, let's say, retail stockbrokers. And you and I know about retail stockbrokers. We've been there. And the level of diversification at the institutional level was much broader than we normally found in the retail world. And therefore, it tended to reduce volatility a bit more. And that, in this world, I think is what people are looking for.
But people have always thought that the same asset classes sort of behaved the same way every single year. There was a sort of common theme. But we actually found out they were going all over the place.
And they have done, and they probably will continue to. So by asset classes, what we mean is, by example, equities, or stocks and shares, is an asset class. Fixed interest, or gilts, is an asset class. Property is an asset class. Commodities is an asset class.
So how many different asset classes would you expect to see in a well-diversified portfolio?
You'd probably look to see at least a half a dozen asset classes, but in addition to the asset classes themselves, then diversification according to geography. So within equities, you might have emerging markets, you might have North American, you might have European. Within fixed interest, you might have gilts, you might have corporates, you might have index linked. Within each asset class, there are further ways to diversify.
So lots of little subdivisions.
Yes.
So actually, when you look at this historically, we've got a rather good picture of this when it actually shows all the different colours, and we call it the mosaic. But how do we measure how all of these different asset classes behave?
Well, what we're trying to do is to get asset classes that we can piece together into a portfolio for a client that don't behave the same way.
Now, this is when you come out, a terrible word you have. What is it? Correlation.
Yes, it's another word we use to confuse people.
Yeah.
So we'll try to get rid of that word correlations. But if you break it down, actually, is how do they relate to each other, or how do they co-relate to each other?
So what do we actually aim then to achieve? We've got these wonderful things where we understand how they behave with one another. What's the end goal?
Well, the holy grail of asset allocation, I suppose, is that if you've got one asset class that's going up, the other one's going sideways, and then 6 months, 9 months, 12 months later, they may reverse pitch.
So now I think we've got another slide where we can actually show what we have done over the years, and these white boxes actually plotting the way through this strange mosaic. That's what we're aiming for?
Yes, what we're really trying to do is to work our way through the middle of the page, if you will. We don't expect to be able to be at the top all the time because we don't have a crystal ball, and we want to make very sure that our clients are not down at the bottom. And by diversifying, we think we greatly increase the probability that we can travel through the middle of the page, thereby enabling clients to sleep better at night.
So, less volatility, manage the risk. So what does this actually look like? This is an example of the portfolios. Just talk us through what this sort of balanced portfolio consists of.
A balanced portfolio would have a certain amount in equities, on average about 40%. We'd have a certain amount in the different types of fixed interest, and there are several different types that we just mentioned. And then we would have what we call other or alternative asset classes, which would make up the balance of the portfolio. And the equities and the fixed interest tend to behave very differently. And so the trick is to find the alternative asset classes that don't behave like either one of the first two.
Okay, so you end up neutralizing it and you end up therefore with a steadier result.
Yeah, that's the idea.
Okay.
So Justin, let me ask you a question. What's so important about asset allocation?
Well, it's interesting because when you go back and look at the figures on asset allocation, history actually shows us that it looks like it's the longer term driver. If you compare all the different issues, for instance, stock selection and market timing, it's not that they're unimportant, but actually figures show that somewhere between 85 and mid-90% of historical returns are driven from being in the right asset class. So if you just get that basic issue right of which one of those buckets we're actually going to be in, then we've got a reasonable chance of actually making some money for clients.
So it's the most important decision that we have to make.
Well, there you are. That's asset allocation. It's not just more eggs in more baskets, it's more baskets as well. Hope that makes sense.